Welcome to the Menhaden Resource Efficiency Investor Update call. We're just waiting a few more seconds for the system to admit all the participants. I'd just like to run through a few admin points. If at any point you have issues or drop off, please email distribution@frostro.com and the team will assist as best they can. We will distribute the presentation slides after this call, and there will also be a recording available. The format of the call will be a presentation from Ben Goldsmith and Luciano Suana, the portfolio management team of Menhaden Resource Efficiency. This will then be followed by a question and answer session. At the bottom of your screen, you should see three icons: chat, raise hand, Q&A. Please use the Q&A button to submit your written questions at any time, and these will be answered after the presentation. There's been a very interesting time in the markets of late, not least since inflation reared its head in earnest. Central banks made a move on interest rates and the Ukrainian invasion started. With this backdrop in mind, Menhaden Resource Efficiency continues to be focused on quality global investments, both public and private, which are delivering or benefiting from the efficient use of energy and resources. This investment focus, especially given inflationary costs, particularly in the energy sector, increasing for businesses around the world, has played out well in the trust returns, and the team believes this focus will play an important role for the foreseeable future, not just from short-term post-COVID inflation expectations, but from the seismic shift during the last few years in the investment industry's approach to sustainability and efficiency. I will now hand over to Ben and Luciano to speak in detail about the trust positioning, performance, and outlook for the future.
Thanks very much, Matthew. This is very kind of you to have organised this for us. I think probably before we jump into the detail, I might just recap what we set out to do when we launched Menhaden in July 2015. I previously set up WHEB Asset Management, which is a specialist sustainability themed equities manager, which currently runs approximately £1.5 billion in an open-ended fund, a single open-ended fund, about 70 underlying positions, and which is focused on a theme which we used to describe when I worked in WHEB as the green industrial revolution. I've always figured that at the heart of that story is the transition by all industrial sectors to the more efficient use of energy, water, raw materials, waste streams, and so on. So when we set up Menhaden, the idea was to continue that focus on energy and resource efficiency. But I came to the idea that it would work well to address the theme in the context of a permanent capital vehicle, a closed-ended vehicle. I began conversations with Graham Thomas, who'd been chairman of the executive committee at RIT, which many of our listeners will know. That's Jacob Rothschild's vehicle that has produced wonderful returns over nearly 4 decades. And I guess the thinking was that a permanent capital vehicle that the investment trust provides allows you to take a patient long-term approach in the way that other kinds of funds can't. You don't have a time limit, the kind of 10-year life of a private equity fund, for example. You don't have the sword of Damocles of fund withdrawal hanging over your head each day. And you can take a longer term view, and you can get involved thereby in more esoteric positions. In Menhaden, we've made some investments in private equity and private credit situations that we wouldn't have been able to do through an open-ended fund structure. So I guess we invest a little bit more like a family office than other kinds of investors, and we're able to flex the asset mix in our portfolio according to how we see the world. So I wanted to apply that methodology to the energy and resource efficiency theme. And so with Graham as chairman, half a day a week, we managed to launch the business in an IPO in July 2015. And it's fair to say we didn't have the best start. Some of our listeners will have known us since then, but during the first 9 months, we suffered some write-offs and write-downs in what, with hindsight, was a bit of a mishmash of venture and growth capital investments that we inherited at the IPO. We also got involved in a binary outcome situation in the form of the bonds of Abengoa, one of Europe's leading solar players. And the long and the short is that we were in a bit of a pickle after 9 months, and we invited Luciano Suana to come in, who'd been at Barclays as a credit investor for many years, and to come and take a look at our investment strategy. And what we decided with Luciano's input was to narrow the investment focus, really to follow the Buffett school approach. And we decided to effectively look at investments through a Venn diagram with 3 circles. And we'll come to those in a moment. But really the first of those is the theme. Do these businesses that we're looking at either deliver or materially benefit from the more efficient use of energy or other resources? The second circle is quality. So we only look at businesses, whether they're publicly traded or private, that have strong balance sheets, which have cash flows that we can really understand and predict with some degree of comfort, and which have strong competitive positioning, high entry barriers. We try to avoid use of the term monopolistic or oligopolistic characteristics, but really, if you boil it down, that's what we're looking for. Companies that have pricing power, which of course is increasingly important in the current inflationary environment. And the third circle of the Venn diagram is value. So following the Buffett school approach, trying to access these positions at good valuations. And the portfolio underwent a revolution during that year, that second year of our existence, in which we switched out of some of the higher multiple investments, companies like Acuity Brands, which is a brilliant business. It's a market leader in LED lighting, but trades on a very high multiple, and you're reliant on continued annual growth in order to underpin that valuation, into some of the more value-orientated stocks that we've had in the portfolio during the last 6 years. And that's worked. We've produced nearly mid-teen annually compounding IRRs during those 6 years, net of costs. And we've rebuilt the NAV to the extent that today we've got 125 million pounds or thereabouts under management, having launched with 80 in 2015. The share price still trades at a discount, so we've got a market cap of 90 million pounds, a share price of about £1.08. I guess the challenge for this year is going to be to work as much on the share price as we do on the NAV. Now, our focus has been overwhelmingly on delivering great risk-adjusted returns, and what we've built in terms of a strategy and investment team is working in that regard. We haven't paid as much attention to the share price, and we recognize that the discount is frustrating for existing holders, albeit an opportunity for potential new buyers. And hence this webinar, it's the second one we've done in the space of 3 weeks. So we actually have a deck, but I think I think rather than walk you through it, I think what we'll do is refer to it during questions. And I thought I'll just tell you a bit more of the story now, in the way that we did 3 weeks ago. So the team of Menhaden is me as chief executive, with a particular focus on the private deals that we do. We have Graham chairing our investment committee still on a part-time basis. Luciano is the lead portfolio manager and CIO. And we have Teddy Pybus is our analyst, who is obviously full-time reporting to Luciano. The board of the PLC, which is independent from us as the management company, is chaired by Sir Ian Cheshire. And the reason why we asked Ian to chair the board is because he was pretty much the first FTSE 100 chief executive to dive headfirst into the energy and resource efficiency story. Kingfisher invested massively in everything from fuel efficient trucks to LED lighting to ultra efficient refrigeration in its stores. And alongside Marks and Spencer, which was led at the time by Stuart Rose, whose program at Marks and Spencer was called Plan A, with the strapline, because we have no plan B. The two chief executives ultimately reaped the rewards of those programs after enduring several years of pillory from the city and shareholders for huge amounts of capex on green stuff. Very quickly, both saw that those programs paid for themselves and more. So he gets it, and that's why we wanted him to chair the board of this PLC. Duncan Budge is on the board. He's an old timer in the world of investment trusts, sits on the board of a number of investment trusts, and worked with Graham at RAT. Emma Howard Boyd is chairman of the Environment Agency and previously was a senior figure in Jupiter's investment team. And then Howard Pierce is also on the board, who has a great track record investing in, managing public sector pension funds. Howard ran the hugely successful Environment Agency pension fund for a number of years and won lots of awards for doing that, and has a particular focus on sustainability investing. And the strategy with which we set out was really a capital preservation strategy. Once Luciano joined us as CIO, and we developed our new way of looking at the world, capital preservation is really front and center in our minds whenever we consider any investment, looking to balance risk and reward across equity, credit, and private universes. We can take a flexible approach as far as geography goes, but in practice, we're investing in the US and Europe and developed markets. We have a bit of an angle on Brazil. Luciano worked in Brazil in Barclays for a long time and has a great network there. And we've had one foray into Brazil, which worked out very well for us. And we'll talk about that when we cover the portfolio in a moment. And we always said from the start that we'll run a concentrated portfolio, and we want each position to matter to us. We want to know each position inside out. So we run a conviction portfolio of between 50 and 20 positions. We don't know that we're smart enough to find 30, 40, 50 plus positions. So the highest conviction ideas end up being more than 10% of NAV. In fact, our biggest position at the moment is a little more than a quarter of our NAV. And low turnover, long-term approach. So I guess in terms of the current landscape, we all see in all industrial sectors the pace of innovation accelerating very, very fast. The rate of destruction and creation seems to be a whole order of magnitude faster than it was when I first joined Hargreave Hale Stockbrokers in 2000. And the leading active investors are playing an increasingly difficult game. That's one of the reasons why we seek to invest in a limited number of positions, and why we look for companies with really strong competitive moats, which appear to be under siege across all sectors. The resource efficiency theme is an outlier in the sense that the transition is accelerating very, very fast. You barely have to kind of open any newspaper or magazine to see that companies are falling over themselves to move from linear economic model, where you pull stuff out of the ground, turn it into something, and then chuck it away into a landfill site or an incinerator, to a circular model where stuff gets used over and over again in the form of reuse, recycling, upcycling, and so on. And there's all sorts of dramatic business model shifts that have taken place in recent years that illustrate this shift. I think the story of Philips in Germany, I think, is one of the most interesting in recent years, whereby Philips was in the business of supplying light bulbs and hardware to the German road system, and of course had very little incentive to produce light bulbs that were electricity efficient, nor hardware that minimized maintenance requirements, because those costs fell upon the customer. And then the German Highways Agency said, well, in fact, we'd like to look at this a different way. We'd like Philips to supply us with lumens, and we'd like to pay you by the kilometer of road that you illuminate for us. And immediately a great incentive was placed upon Philips to produce hardware that needs minimal maintenance, bulbs which last a long time, and which use as little electricity as possible. And so that kind of circularity is appearing across industrial sectors. And that thematically is what most interests us. Businesses which are absolutely delivering or directly and materially benefiting from that transition. And we'll explain by way of illustration some of the positions we've chosen in that light. The portfolio today is overwhelmingly geared towards publicly traded investments. In practice, we seek to have around 2/3 of the portfolio allocated to publicly traded investments and 1/3 in private equity, private credit. We found that harder in recent months to achieve, on the basis that there seems to be a valuation mismatch between public equity markets and private markets. And we find that a lot of the private equity firms with whom we are regularly looking at deals and with whom we have co-invested in the past are falling perhaps into the business of paying up for some of these assets using large amounts of leverage. And we find that the risk reward matrix is starting to look more appealing in public equity markets. As a result, at the moment, we only have one really meaningful private investment in the portfolio and two slightly smaller ones in private equity, private credit. And around 85% of the portfolio is invested in our listed equity positions. But the target is 2/3, 1/3, public versus private. Luciano, I wonder if it's worth you sharing the screen and showing slide 8. So that's the progression of the NAV since March 16, which was the low point. And you'll see that with a relatively low volatility and with more or less continued outperformance, we've managed to rebuild the NAV, and what we're doing is working. So we are, I guess, one of the reasons why we're so willing now to participate in these kind of webinars and to get out and talk to prospective investors and drum up interest in the equity is that we're no longer, or I'm no longer, in the kind of apologetic crouch that I was in between, say, 2016 and 2019. You know, we have confidence that what we do works and that we can continue producing great risk-adjusted returns doing what we do, and that has started to pay off. Do you mind jumping, Luciano, to slide 10, just so we can look at the NAV versus the share price? The NAV versus, so you'll see the discount has been more or less consistent, and I think that is simply a function of the effort we've put into marketing. There've been a couple of lumpy sellers in during the last year, IPO investors who'd been with us 5 years or 6 years who decided that they'd get out once the share price had tipped above the IPO price. We don't see that kind of selling pressure at the moment. So we hope that with a few more of these webinars and a little bit of effort on our part, marketing to prospective investors, we hope that the share price will begin to move. It's certainly something that for the first time we're really going to pay attention to now, because this is completely erroneous. The market is mispricing the value of our shares, given the performance and given the underlying assets, which, if we jump back one slide, you can see are comprised of blue chip businesses, mostly publicly traded. So I wonder if, I'm sure these will be among the questions that you ask us, but I thought what we do is we'll pick some of these and describe to you why we did them and what the thinking is. And I'll start with Xelio, which is our only major private position. And in fact, it was our first private position after the IPO. And Xelio is a Spanish headquartered but global solar asset developer operator. The principal backer is KKR, and we were invited to co-invest on a no-fee basis with KKR in that deal. And what they do is build solar assets in countries where you have high power prices and lots of sunshine, and therefore no need for government fiscal support to underpin the economics of those assets. And it's a team which is extremely conservative and prudent in, for example, their use of leverage, but which is also entrepreneurial and very canny in opportunistically selling assets when the opportunity arises. Xelio, for example, has recently sold its entire Spanish portfolio of assets to China Three Gorges. They did the same with their Japanese assets 18 months earlier on an implied IRR of more than 40% during those 3 years. So this is a business that we're happy investing in, particularly on the basis that KKR is leading the oversight. Brookfield has recently joined as a co-investor with KKR. They bought out half the business, and we took half our money off the table at that time at a return on investment of around 2x. And between Brookfield and KKR, we think the business is in safe hands. What we particularly like is that the development activities represent upside. The existing portfolio of assets in Xelio are throwing off cash and producing a low single-digit yield for us reliably year in, year out. So there is a kind of downside protection there inherent in the quality of the existing assets. The upside all falls in the development activity, which Xelio is very, very good at. As a result, we're sitting on 2 times our money with that deal, and that's exactly the kind of deal that we've asked to co-invest with KKR on. We made a similar investment with KKR shortly afterwards in a business called Allocation, which for a while was listed on the FTSE 250 before being sold out. And we made 2 times our money. That's a company which is the UK market leader in domestic energy metering. So at the time we sold our position, they were operating 12 million energy meters in people's homes up and down the UK, and a load more in Australia, where the business is growing even faster. So again, a bunch of assets with very, very sticky contracted revenues. You know, even if the homeowner changed utility, the contract to run the meter remained with Allocation for 20 years, in some cases 30 years. And in most of that portfolio, those revenues were inflation linked as well. So that's the kind of deal we're looking for. There's solid assets with predictable cash flows and a blue chip lead investor behind whom we are co-investing on preferential terms. John Lang is the third co-investment we've done with KKR. That's second from bottom. We completed that deal in December 2021, and that was the buyout of John Lang, which is a portfolio of infrastructure assets in the UK, including a bunch of renewables and other things. We've made similar investments with Apollo, co-invested on a fee-free basis in a real estate transaction in Berlin. We made a 25% ROI upon exit in the same year in which we made the investment. And we also co-invested with a group called Perfin in Brazil, that Luciano knows well, in a portfolio of electricity transmission assets, both development and operating. And we made 4 times our money in 3 years in that deal in sterling, and that worked out well. So the model on private investing is to co-invest with the best in deals which meet our own investment criteria, which are energy and resource efficiency, quality, and value. So I think that's one of the aspects that we most like about the structure we're using at the moment, is our ability to get into these kinds of deals and to take advantage of the network that we've built up. Our shareholder base comprises mostly retail wealth managers and IFAs and so on, but also we have a significant number of really successful business people in there on their own account. And they show us deals the whole time, and they open their network for us. And an ability to take advantage of those connections, I think, is an important part of our story. And so we are putting a lot of effort now into looking for new private deals at the right price. So with that, I wonder, Luciano, if you'd like to briefly introduce yourself and then just pick 2 or 3 of our biggest public equity holdings and describe the rationale for those positions, and then we might go into Q&A.
Yep. So my background, I started at Kleinwort Benson in M&A. After that, internally, I moved within Dresdner Bank when Dresdner bought Kleinwort Benson to their credit derivatives unit and managed an area called illiquids. We were managing up to 6 billion euros of assets. I was managing a group of 9 people. After that, I moved to Barclays, where I managed and set up their credit trading business in Brazil. At the end of 2015, I was introduced to Ben, and in 2016, I joined them. So in terms of the portfolio, you'll see that all those companies, perhaps with the exception of Xelio, they have something in common. They have a high pricing power. They're effectively monopolies or oligopolies. That's very important in the current backdrop of potential high inflation. We want to own businesses that can pass that inflation to their customers. So the likes of Alphabet, and Microsoft, Safran, Canadian Pacific, Canadian National, have all massive pricing power. In terms of choosing one, I think probably we should talk a bit about Alphabet, because it's such a big position and we're still very excited about it. I think everybody knows Google, and I think one of the important points to mention is that currently more than half of the NAV represents profit, because we started the position more than 3 years ago, and we scaled up the position just after the beginning of the COVID crisis, and it worked out pretty well for us. We think, despite all this current performance in price from Alphabet, we're still very excited about the position, because more than all that performance has come through earnings growth, not multiple expansions. The company is still trading at approximately 22, 23 times earnings. And if you strip out the cash and the value of Google Cloud, probably the company is trading at an earnings of approximately 17 to 18 times. So we still envisage very high returns for Alphabet, approximately north of 15% for the next 3 to 5 years. It's super interesting to mention that Alphabet is the leader in AI. And AI is an information business, and the fact that the data that Alphabet is predominantly a data and AI company makes us very excited with the prospects in the future. Things like education and healthcare and call centers could benefit massively from the technology that Alphabet is developing. In the case of Microsoft, I think it's another interesting position. It's probably how we see Alphabet in the next 10, 15 years, because Microsoft went through the same things. They had massive cash pile. They were not paying dividends. They didn't have any leverage. So we see that the capital structure of Microsoft probably is how Alphabet will look like in a few years. Microsoft is probably a bit more expensive than Alphabet.
Luciano, sorry to interrupt you. We've had a question into the Q&A specifically on the energy and resource efficiency angle around Google. So if we can elaborate further on that, that would be great.
Yeah. So it's Alphabet is one of the larger users of energy in the world, and 100% of the energy they use comes from renewable resources, approximately 90% from wind and the rest from solar. It's also the fact that they have the data centers. Data centers are huge consumers of energy. With some of their proprietary technology that they use from their DeepMind unit, they managed to decrease the use of energy in some of their data centers by as much as 40%, which is remarkable. So they are the best practice, effectively, in terms of resource efficiency in data centers, and they are 100% powered by renewables. In terms, I was mentioning Microsoft. So in terms of valuation, the valuation of Microsoft is materially more expensive than Alphabet, but at the same time, it's a much more predictable business. The leverage in terms of pricing power is huge. And in terms of IRRs, we envisage probably around 12% going forward for the next 3 to 5 years. Charter is a very interesting position because it doesn't fit 100% because there's a bit more competition in their sector. You have all the telcos providing broad, internet going forward, but the cable companies in the US are very well positioned. The Charter and Comcast are very well positioned to compete. Charter is the cheapest out of all the main providers of broadband and wireless, and we see the revenues growing at single digits. We see the EBITDA growing at high single digits, and we see the free cash flow growing at north of 10%. And because Charter has a very clear strategy, which effectively is a leverage public buyout, they will keep that free cash flow levered, and they will keep buying back shares. So Charter could potentially benefit from IRRs of close to 20% for the next 3 to 5 years. So we're very excited with that. I think Canadian Pacific and Canadian National, we can talk of them together. I think they are great positions for inflation hedging because they effectively own the infrastructure. And if you look at what happened at the beginning of the COVID crisis, when volumes plummeted, they managed to keep revenues almost constant by effectively increasing prices, which tells you how much pricing power they have. I think those are like the largest positions, and I think that's a good overview of the logic why we own them. The other thing in terms of quality that we mentioned is there's very little leverage in all the positions that we own, with the exception of Charter, precisely because this is so predictable. The cash flows in Charter, you can keep that cash flow levered. The other thing I would mention is what Ben mentioned in terms of the public and privates, is that privates, traditionally in the past, you would see the public private arbitrage, you would see higher returns with private deals. But we're seeing, especially through Ben, we see a lot of deals especially in renewables. And the issue we see now is that a lot of these private deals offer you returns that are suboptimal, and effectively the only returns that we see that are meaningful are predicated basically on leverage. And some of these deals, higher leverage doesn't make a deal better. It makes it the deal riskier. So if there's a material change in that, eventually, we will definitely increase the private deal bucket materially. At the moment, that is not the case. So I think, Ben, if you want to continue.
Yeah, well, look, that's 30 minutes of us talking. I think we should jump into Q&A, and I hope the question around the resource efficiency angle of Google has been answered. A new question we've got is the impact of the ongoing conflict in Ukraine on the portfolio. Luciano, do you want to answer that?
Yeah, I think, with the exception perhaps of, some of the companies have revenues in Russia, right? Just to mention, Saffron as an example, approximately 2% of the sales comes from Russia. And the impact is also not only from a sales perspective, but some of the materials like titanium. 50% of all titanium used comes from Russia. So that's an issue. But we think that the quality of the portfolio and the pricing power that we have is the best defense that we have in terms of that. We're not involved in anything that has a material or depends on Russia from a revenue or source of materials perspective, with perhaps the exception that I mentioned of Saffron. So we envisage in principle that the impact is going to be relatively low in the portfolio. Charter, just to give an example, is at 100% US-based business. Canadian Pacific is a North American business with operations in Canada, US, and Mexico, and Canadian National is mainly US and Canada business. So the majority of the portfolio is well placed.
So Ben, we have a question on private equity. Can you elaborate more on past private equity exits and whether your outlook for private equity returns match what you have managed in the past? And how does that shape the level of private investments?
So we're definitely bottom up in respect of private equity. So we're looking for deals all the time, and if we find the right one, we do it. But that's very much price driven. And we found it easier 3, 4, even 2 years ago to find opportunities that were a fit from an investment management perspective. Hence Xelio, which we're delighted with, and Callisen, and subsequently, much more recently, John Lang with KKR. The real estate deal in Berlin with Apollo, we had a little bit of a lucky exit in a sense. We invested before all of the Berlin demonstrations around rental caps and so on. And the proposition was that this was a portfolio of dilapidated residential blocks. And the investment was geared towards the renovation of those blocks to make them much more energy efficient, as well as better equipped and refurbished and so on, which then moved the apartments into a higher rental bracket according to Berlin rental regulations. And then there were a whole bunch of protests around potential asset seizures in residential real estate, and certainly rental caps and all of that stuff. And I guess we were quite lucky that a group called Adler came along and bought the whole portfolio at a 25% uplift from the price we paid. But again, the model was similar. It's solid assets with predictable cash flows and some kind of an energy and resource efficiency story there. With Apollo, a proven real estate investor in the driving seat, and then the only one we've done outside of Europe has been the Brazilian electricity transmission infrastructure deal, in which we invested alongside Perfin, who are an old connection of Lucianos. We like to invest where we're not paying investment management fees in the way that in the way that ordinary investors do, because obviously there's the fees on fees issue, and we'd rather not expose our shareholders to that kind of fee layering. So we look for privileged position of some sort when we invest in these deals. And so far, I've not paid management fee to any third party in respect of these investments. It's worth mentioning briefly the TCI fund. We've co-invested on a no management fee basis in a real estate secured credit fund managed by the hedge fund group TCI, Sir Christopher Hone. They only invest they only provide mortgage loans to building projects that are best in class in terms of energy and resource efficiency. They've got to be better than kind of gold standard under the BREEAM or the LEED standards that exist in the US and Europe. These are typically loan to value, kind of 50 to 60% loans, 2 to 3 years. They're to fund development and typically at sort of anywhere between a 10 and a 13% interest rate. And so far they've had a pretty good track record. That fund has produced 11% IRRs for 12 years, but it's kind of a friends and family fund operated by TCI, and we were lucky enough to get in on that. So that's the model. And right now it's fair to say we've looked at a bunch of stuff in the last 3 months, and we've struggled to find deals that these kinds of investors are putting together that we can stomach from a valuation perspective. I think that increasingly they're raising large amounts of money that they're struggling to deploy, and so they're heaping leverage and overpaying for assets. And as a result, we end up with an 85% exposure to publicly traded equities. But we keep looking, and when we find the right things, we'll do it. And our long-term goal is to be at least a third in privately held investments.
Thank you very much. What is the free cash flow yield of the portfolio in aggregate? I assume it is low. So how can you be sure the portfolio is not at risk to structurally higher rates inflation?
In fact, the free cash flow is actually, we think, quite high in the case of especially the likes of Charter, Microsoft, and Alphabet. That's one of the main things that we look in terms of valuation. We avoid deals where we see that there's not going to be a very decent free cash flow returns for us. Just to mention, for instance, the case of Ocean Wilson. Also the other point is that there's very little leverage in the whole portfolio. One of the reasons why we've been avoiding some of the private deals is precisely because we don't want to get involved in high leverage deals. Just to give you an example in terms of the likes of Ocean Wilson, right? It's a deal. It's a holding company with an operating asset in Brazil, which is mainly ports, 2 ports and a towage business, and a portfolio of approximately $335 million on the side. Effectively, we can buy this combined business for approximately 40% discount to NAV. And at the same time, we get paid a yield of north of 5% in sterling. So, free cash flow yield is one of the main metrics that we look at. And the likes of Alphabet, where you have a decent free cash flow yield with no leverage and a massive amount of cash, and a business that is growing at 14-15% a year. I think it's a good place to hide. In relation to the what Ben was saying before, I think that's precisely why we have the liquid stock positions that we own now, is because in terms of quality, we can't find anything as good as the positions that we have. We own some of the best businesses in the world, like Alphabet, Microsoft, the railroads, Safran, and Charter, and we're very happy with the portfolio as it is.
And just another question. Obviously, Menhaden focuses on resource efficiency. In this all things ESG world, where do you think Menhaden sits amongst the other ESG funds? And what are the advantages of this strategy over others?
So I wouldn't describe us as an ESG fund. I don't think we are an ESG fund. We're not an impact fund. We're not an ethical fund. We are a thematically focused investor. So we are interested in the theme of the transition globally to the much more efficient use of energy and resources. That's what we focus on. We are, of course, mindful about environmental, social, and governance considerations, but what decent investor isn't in today's world? I think our view is that companies which are not proactive on these kinds of issues, on their impact on the environment, on the impact, negative and positive, that they produce on society, on the quality of their governance, we think they're probably not very good businesses. We think probably they are subpar in other areas. And there's an increasingly clear financial correlation between mindfulness on environment, social, and governance considerations and on simply running a good business. So we wonder which investor isn't an ESG investor in today's world. So by that token, we are, but only to the extent that we're mindful of these kinds of considerations as in the normal course of our investment process. Do we produce impact? Well, we engage with our portfolio companies. We're big believers in engagement. We write on a reasonably regular basis to the chairman and chief executives of the companies in our portfolio, even the very big ones. We recently received a letter from the investor relations team at Safran, and we heard back from the chairman's office in Charter, and we encourage our companies as a small shareholder to get better in their reporting of their emissions and in their emissions reductions planning and so on. So we engage. We're thoughtful about how we vote in the AGMs of these companies. In extremis, I guess we would divest in the event that we felt a company was seriously going the wrong way on some of these considerations. But we do so because we think that being thoughtless about ESG considerations probably means that you're thoughtless elsewhere as well. So I'd say we're a thematic fund, not an ESG fund. We produce an impact report, which majors on our engagement. And you'll see that in our annual report, which comes out in April. And we outline how we've engaged with the companies in our portfolio, how they've responded, and what kind of a difference we've made in that way. I don't know, I hope that answers the question.
Brilliant. Thank you so much, Ben. Just another one on buybacks. Do the returns of all holdings exceed the potential returns of buying back stock in the trust itself?
I think.
Do you want to go first?
Yeah, I think it's a very interesting question. And the thing is, like, I remember when I joined Menhaden in early 2016, I mean, we were trading at a 30% discount. And the first question was like, should we buy back or not? And one of the things that we noticed was that if you look across the investment trust area in the UK, you will see that closed-end investment trusts that trade below 200 million pounds of market cap have an average discount of approximately 15%. At that time, the bid offer for the shares in Menhaden was 50p, 55p, bid 50, 55p offer, which effectively was like precluding any institutional investor from taking a position in Menhaden, because if you buy Menhaden shares and you show a loss of 10% the day after, it's effectively, a lot of like investors are going to be unable to invest. So we saw that in order to decrease the discount, we should focus on liquidity, making sure that we increase the size of the trust, and that's what we've done, making sure that we focus on performance at NAV level, and we achieved close to 13% IRR at the NAV level right now, and we think that that's the right approach. We need to make sure that the trust gets bigger, that the shares are more liquid. Now we've seen that shares are trading at the 106 and 108p, right? The 106p bid, 108 offer, and I think that's the right the right thing to do. That doesn't mean that eventually there's going to be potentially buybacks, but I think we need to be bigger first.
Brilliant, thank you. Do you see a threat regarding big tech breakups?
Do you want me to go, Ben?
You go first.
Yeah. So in terms of there's definitely a risk in the likes of I think for Facebook that would be a material issue because their business model is predicated on information sharing, and in the case of Alphabet, probably you would see we would make money in such a case because the sum of the parts are would be materially higher than the current valuation that we see. At the same time, it's very difficult to imagine that such a breakup would take place, especially because traditionally in US in the US, like in order to break a monopoly, you have to demonstrate consumer harm. And in the example of Alphabet, it's consumers are not paying for the service. Effectively, the quality of the product is getting better and better because they reinvest. So you cannot force users to go and use Bing as an alternative or any other search engine. So it's clearly a winner takes all kind of business. And if you look at what happened in Microsoft in the early 2000s, I mean, it shows you a perfect precedent. It was tried many times to break Microsoft, and it's a very difficult process.
Brilliant, thank you. How has the last 2 years of increased awareness and focus on resource efficiency and climate change affected the portfolio and your views for the future?
I mean, I think the acceleration in efforts by corporations, investors, governments, and the public to get serious about averting significant climate change and beginning the work of restoring the natural fabric of the world are rewarding, not least in the sense that it validates our original investment thesis. This is a mega trend which is only getting bigger. I think that it's broadened our investment universe. There may well end up being a time where the majority of publicly traded companies somehow fit within our universe. It seems to me that almost every major company across every industrial sector is now very focused on reducing their environmental footprint and in the process reducing their costs. So it's broadening our investment universe. Has it impacted positively on our returns? I mean, I guess those companies that do find their way into our portfolio are benefiting in the form of increased resilience to ever more volatile global commodity prices and reduced costs generally. Investments that have paid off. The investment that Microsoft and Google have made in renewable energy capacity, for example, have most certainly paid off. So I don't know what you want to add to that, Luciano, if anything.
I think the other thing which is not, I think that is important to note is the acceleration in transition towards cloud and digitization. In the last 2 years, effectively, it's what happening. It's what the companies like Alphabet and Microsoft were envisaging, that it would take perhaps 5-6 years. So there's been a massive acceleration in that trend, and we're very excited because we own 2 of the best businesses for that. And in terms of the trend will continue, and technology probably will increase the percentage of global GDP and perhaps even double according to This is something that the CEO of Microsoft mentioned more than a year ago. So, that's another trend that we've been seeing, and we are very happy that we own, Alphabet and Microsoft.
Brilliant, thank you. And just one more question. Could you elaborate slightly more on the concentration risk reward dynamic within the trust?
I think, I mentioned that during the presentation, that the reason why we have Alphabet and it represents, close to 30% of our portfolio is the fact that even though it has, more than doubled since in terms of the weighted average price that we entered, we still see material upside. If you look at historical price earnings ratio of the Nasdaq, you'll see that it's historically close to 25 times. Alphabet currently trades below that, and if you take out the cash and Google Cloud, it's close to 17, 18 times. So we see, if the prices change and we see a material expansion of multiple, we'll definitely decrease the position. But in terms of the current risk return, we're obsessed with the fact that we are trying to avoid asymmetric risks. We want to have meaningful upside and limit our downside, and I think the portfolio does that.
Brilliant, thank you. I think that comes to the end of our questions. So if there are no more, I'd just like to thank Ben and Luciano for their presentation, and also to all the participants for listening in. If you have any further questions, please email us at distribution@frostro.com. And we're very much looking forward to talking again soon, and hopefully have some one-to-one meetings. So thank you again, Ben and Luciano, and have a lovely day.
Thank you very much, Matthew.